Last week we saw the stock markets do quite well. Earnings have been good, and we'll take a look at what's happening this week. Earnings season really gets underway this week. There is a company that reports this week that I'm following closely that other investors are not following that closely. I think it's a big one. It's Blue Owl, and Blue Owl is going to hoot their earnings on Thursday. So I'm going to talk about why their earnings are important in this video today. We'll take a look at some of the sector performance that took place last week. Gold had a really down day on Tuesday. What happened? What we can expect coming up shortly as well. And we'll take a look at the overall trends in the market. So let's jump right in and take a look at what happened last week with the major sectors of the market. Here you can see the S&P 500 up 1.9%, technology up 3%. So this was a sign of a risk-on move. Healthcare was interesting. Healthcare has actually been doing quite well relative to the market recently. There's been a shift over the last couple of months in that sector, but the other two major sectors in the market that were defensive, consumer staples and utilities, were actually negative last week. Energy put in a solid week as well. Overall, a risk-on move in the markets with the technology sector dominating. If we take a look at some of the other markets here, we saw small caps up 2.5%, and you would expect that in a risk-on move. TSX up 0.8%, largely affected by the metals and mining companies. Gold miners brought that sector down as well. We saw China up last week over 3%, emerging markets up 1.5%. So last week we saw gold down 3.3%, gold miners down 7.5%, silver down 6.4%. Those are big drops in the market. We've seen gold up week after week after week, and last week we saw an air pocket on Tuesday. We'll talk about that in a second. We saw natural gas up 9.3%. That's a very volatile commodity, obviously. Has a good positive backdrop overall because companies are going to have to, data center companies can't use nuclear right away. Yes, they want to use nuclear down the road, but that can take 10 to 15 years to build out. Particularly in Canada, it's a long cycle on a go-forward basis. And so they've got to be able to power their data centers in the shorter term. And natural gas is the preferred way to do that at this time, given its characteristics for base loading, etc., versus renewables. Uranium was down 3.4% last week. And uranium has been doing well, but got caught in that downdraft where we saw the mining stocks actually perform poorly. Here we are for the Canadian stock market. We see the technology sector up 6.4%. When you find CLS, Celestica performing well, and also Shopify, both those stocks perform well, and they drove that sector higher. Okay, so let's take a quick look at gold here. We can see here, this is Tuesday right here, this big bar here. So the open here and then the close. It was down over 6% on the day. So why did it drop? Gold has been going up week after week after week. And then on a monthly basis, it became the most historically overbought that it has ever been. And in other words, it just got too far ahead of itself. And it's natural for things to pull back. Now, we are in a weaker seasonal period for gold, October, so it's natural that it could happen at that time. It doesn't necessarily mean it's going to happen, of course. But the good news is what we saw afterwards is we saw stability take place. Really, we saw gold here do quite well overall for the week. After Tuesday, at least stabilized. We didn't see this follow on where we saw it go down. And maybe that happens this week. We'll have to see what happens. If we take a look, here's the RSI here, and this is on a daily basis. But you can see here it did cross over here and produce a sell signal. Okay, here's gold on a longer term basis. If you take a look here with the pattern, what we're seeing here is we're seeing a secular bull market for gold. Let me just try and get this straight here. This is a consolidation that took place. Then we see a rally. Then we see another consolidation taking place here. And then we see a rally and a mini consolidation, rally, mini consolidation, rally. And then we go up here and we've seen another consolidation. Now, it's actually quite recent over the last few months. Just up until really September. taking place, and we saw this really parabolic move, and we've seen that pull back. So this is a sign, what we see for gold in a secular bull market. We tend to see this pattern taking place. We haven't seen that pattern breaking down yet. We didn't see this breakdown where all of a sudden we saw it break down lower out of that consolidation. We saw it break out higher. So far, that's strong. So we don't know what the consolidation pattern could be if we are seeing one at this point. Maybe it just continues to move up here, of course. But we are into that period where, on a seasonal basis, where gold can pull back a little bit here. So maybe we do see a consolidation take place. Look for a bottom to take place. Maybe we go back up again, another bottom here as well. It's totally possible for that to happen. There's no signs that we're going to see a big catastrophic crash for gold necessarily at this point. Here's RSI here, and you can see here on a daily basis we did see it actually cross below 70. And as I said, produce a sell signal for gold if you're following that signal. I do want to say that gold starts its next strong seasonal period in December, which is not that far away, and sometimes it can actually happen in November. So gold is, despite pulling back here, still could do really well coming up very shortly in its next seasonal period. So it doesn't mean that, yes, it's pulling back and crashing. It does have a strong seasonal period coming up shortly. In a previous video, I talked about First Brands and a Tricolor going into bankruptcy. And the question was, these two companies dealing in this market, are they the canary in the coal mine for this sector of the market? Or are these just one-offs? Because there's a lot of fraud alleged with, in this case of First Brands, with their factoring. They were double pledging their assets on their factoring for receivables. And so, the debate is there, but we're starting to see liquidity overall in the market starting to dry up in the market. And so we could see more of this take place. In fact, last week we did see that happen. Last week we saw subprime lender, Primalend, go bankrupt. And there was not only that company, but also another company. So a lot of this is focused in some of the subprime space. But the big question is this going to broaden out? Because if we take a look at some of the factors taking place here, we're seeing higher car repossessions, we're seeing higher credit card defaults. Basically, we're seeing the consumer in trouble, particularly in the bottom 4/5 of the income earning potential. I've talked about this in the past as far as COVID distribution money and what took place, etc. So that part of the market is really starting to show some stress here. And right now, investors are questioning, will this continue? Is this just the start? If we look at the consumer discretionary space, and here I'm using the ETF XLY here, and you can see here for 2025, it's up slightly, but relative to the market, we saw it pull back down substantially coming into the self-proclaimed Liberation Day. And then, we've seen the sideways move. But my concern is we're starting to see the consumer discretionary companies really starting to suffer here a little bit. And performance-wise, we are on this downward trend here. Now, we haven't really broken below this as far as relative to the S&P 500. My concern will be if it breaks below that. We are seeing some individual companies in this space really starting to suffer, and that is a concern. Last week on Friday, we saw the CPI report come out. It was expected for the CPI to come in at 3.1%. Actually, what took place was we saw the CPI year-over-year inflation come in at 3%, so slightly better than expected. And the core also came in at 3% as well. Here you can see that with the blue and white lines, both 3% overall. I do want to point out here that basically that CPI is still moving higher or slightly higher over the last few months. We haven't seen the resumption of a downward trend yet. And this is the concern. We're still well above target of 2%. Maybe we do see inflation start to correct here. But so far, we haven't seen a substantial move in that. And that's maybe why the stock market didn't really rally extremely strongly off of this announcement, because are still well above target. We're not seeing some big, huge strides to get down to that 2% target, or even below that as well. This week is a busy week. We've got the FOMC coming out with their announcement as far as interest rates go. We'll talk about that in a second. That will come out as scheduled, but government reports coming out this week are obviously iffy, depending on the situation, what takes place with the government shutdown. We do see on Thursday, we see the GDP annualized quarter-over-quarter growth coming out. And later in the week, we see, in this case, we see the core PCE index on Friday coming out, and that's expected to come in at 2.9%. But let's take a quick look. Here we have it. This is the expectations of the market as far as the Federal Reserve cutting. Current rate in the upper bound is 4.25%. Expectations are over 96% that the Federal Reserve will cut rates this Wednesday. When it's above 80%, it's pretty well a done deal in the marketplace. The Federal Reserve follows through, and we're seeing the same situation as far as the December cut as well. So we're looking at two cuts coming up for the Federal Reserve, one this week and one in December as well. Here's the GDP. I'm not sure if this number will be coming out. The expectations are for 3%. I do want to go back on a quarter-over-quarter basis. Look at Q1 here. We can see this red bar here. This is net exports, right? So that's part of the GDP equation. Companies were front-running the tariffs, so they were importing a bunch of stuff, which brings down net exports. So we saw that take place. Then in Q2, we saw companies actually reduce their imports because of the tariffs, and we saw this effect on the net exports take place. It's hard to figure out what's going to happen when you see these things really bounce around here, but the expectations are for 3%. On Friday, we've got the PCE, I should say, inflation report coming out. It's expected to come in at 2.9%, so still well above the 2% target. And if you take a look here, we can see here that we're actually seeing this track a little bit higher here for this results. And if we take a look, this blue line is super core. So that is core, take away the housing as well. So core is when you take out energy and food. Super core is when you take out energy, food, and housing as well. So it's at 3.4%. Once again, we're still not seeing that downward trend, so this will be interesting. This could be a market mover this week if we did see inflation come in substantially less than expected. We could see the markets respond positively to that. I want to show you this chart here. So I want to focus on this column here, which is the fund flows for last week. And I've used ETFs so we can see the fund flows. Here we can see that money flowed into, and this isn't ratioed relative to the percentage of the sector compared to the market, but it does give you some indication of what's taking place. You can see technology, there's money flowing in, utilities, interesting enough, money flowing in. So let's take a look at the ones that are flowing out. Here we got financials. I'm going to focus on that in a second, and also consumer discretionary as well. So we're seeing those two sectors, those two parts of the market. Investors aren't favoring those parts as they're both underperforming. On Monday after the bell, we got Celestica coming out with its earnings. This company has benefited from helping to build out with the data centers. It's done extremely well. Tuesday morning before the bell, we got UPS coming out. Just like I said, with the consumer discretionary sector not performing that well, UPS, the delivery side, has not been performing very well over the last couple of years and has been underperforming the S&P 500. If we take a look here and we slip over into, let's take a look at Wednesday. We got some big names coming out on Wednesday. We got Meta coming out, Microsoft, Alphabet. Well, all these are well followed. Then we have Chipotle. Chipotle, once again, consumer discretionary, has been underperforming here. So you see the theme here for this. They've been underperforming. And if we take a look here at Starbucks, we see Starbucks also has been underperforming. What part of the consumer discretionary? Again, it's going to be interesting to see what their forecasts are and if they're seeing any pickup here. I'm not so sure they have strong forecasts unless they're doing something unique to the company themselves. On Thursday, we've got Blue Owl coming out with its earnings. I want to talk about Blue Owl. Most investors are not following this company. I am. I think it's an interesting barometer of what's taking place right now. So Blue Owl, before the bell, comes out and hoots its earnings. a little pun, on Thursday morning. But what is Blue Owl? In my October Thackeray's newsletter, which you can get actually, by the way, free subscription here at alphamanson.com, I talk about what a BDC is, Business Development Corporation. BDCs, and Blue Owl is a BDC. These BDCs are companies that basically lend to small and medium-sized companies and distressed companies as well. And so banks have trouble lending to these type of companies because of all the regulations in place that's taken place. So they lend to other companies that then lend to the distressed companies or private equity or private capital or private equity or private credit as well. So there's a chain going on. So although banks can't do it, they passed on the risk to somewhere else here. And so this part of the market here is showing signs of stress. And so I talk about this in my newsletter here. And here's a graph that I put in the newsletter here. And the white line is actually BDC, which is OBDC, which is the Blue Owl. And you can see how it's turned down. And that's relative. In this case, this is to high yield spreads. If we take a look here, here's another graph, and this is BDC Corporation. So not just it's an ETF of these companies. So it's not just Blue Owl. You can see here the correlation is actually quite strong with something like credit default swap spreads inverted. But we can see that in this case, these BDCs are showing real signs of stress. So we're seeing some of these companies go bankrupt, the smaller companies. We saw First Brands, Tricolor, and as I pointed out, Primalend. So we're seeing these companies having real stress, and it's being reflected through the BDC companies. So it's going to be very interesting, and here's just another way of looking at it as well. So what's happened, and I talk about this in the newsletter, is we're seeing these signals breaking down. So typically you could follow something, and I follow it, the credit spread, which is how much investors are willing to take for high yield or junk bonds credit versus government, right? And so at the time I wrote the newsletter, it was 2.68%, which is nothing. That's historically low. So the market's being really distorted by a whole bunch of new stuff that's been happening with private equity coming in and taking out some of doing what's called a take private transaction by taking out some of the companies in the Russell 2000 and small cap indexes. And these are typically some of the weaker companies. So everything's being distorted here. So it's very difficult to use a credit spread as an indicator, but we are seeing stress in these BDCs. And so this is why it's important on Thursday morning to see some of the comments from Blue Owl. And here's just a clearer picture of Blue Owl. You can see it hasn't really fallen that much. Really, over the last year and a half, it's been fairly flat. It has come back down here. But we'll have to see what's happening. And look relative to the S&P 500, though. This is actually falling here. So this is why we're seeing stress in things like the regional banks as well. So the smaller part of that financials sector. So the big banks have come out with some decent earnings, and investors like that. But the other part of that, investors are not so keen on, would be something like the BDCs and some of the regional banks as well. Okay, on Thursday after the bell closed, we got Amazon coming out. I want to take a look at what's happening with Amazon, bellwether company that investors follow, hasn't really been performing that well. Once again, we're taking a look at some of that consumer discretionary effect taking place. Apple, we'll have to see what happens coming out of a well-followed company as well, going through that. On Friday, before the open, we've got ExxonMobil and Chevron coming out with their earnings. Take your pick. They're both underperforming here. We've seen these companies stumble here over the last couple of years. That's because, oil just hasn't done that well. We're seeing a price of oil at $58, $62 in that range here, despite some of the war situation, etc. But and it's difficult for companies to do well in that environment. We've also got CN coming out with its earnings before the bell. This company's been underperforming over the last while. At the same time, we've seen the transportation sector underperforming. So if you take a look at the overall theme for what's happening in the marketplace, we're seeing the consumer discretionary sector, although it's entering a strong seasonal period coming up starting this week. Most sectors are, anything cyclical and The growth tends to start performing well at this time. We're seeing the consumer discretionary sector stumbling. It'll be interesting to follow and see what happens with the retail sector as well. We're seeing the financial sector stumbling a little bit in the U.S., not Canada. The Canadian banks are doing well. They're a different animal. But that financial sector is mainly the regional banks and some of the shadow banking system, and including the BDCs as well, stumble here as well. So we're seeing this. Yes, the market's doing well. Technology's come back. It's roared back to life. And investors say, yeah, great, let's get on board. We love this trade. But I think you have to be selective in the markets right now, even with the sectors that can do well in the strong seasonal period. So the governments are spending money. They're trying to build out infrastructure, so you can that would help to impact things like the industrial sector. So I think the industrial sector can do well. But it's just the consumer side. It just seems weak. We've seen some really weak signals for a long time, and they just keep building and building and building. So I wouldn't be surprised to see this sector continue to underperform. This week starts off the strong seasonal period for the market, where the market tends to perform better in this 6 months compared to the last 6 months. And we've seen the market actually perform well in August and September. Typically, those are not strong months for the market, but we're seeing an investment fervor right now in the markets. And this can continue to go on. In fact, it can build. So we could see the markets, despite performing well over the last couple of months, continue to perform well in November and December, which tend to be two of the stronger months of the year. Well, it's going to be an interesting week once again. Thank you very much for joining me. If you like this video, please click the like button below, and please consider subscribing to the channel as well. We'll make sure you get the regular updates. Thank you very much.